You need to be aligned to make a successful purchase and a successful integration. Both the vendor and the purchaser need to be completely aligned in terms of what you want to achieve, which is basically as smooth a transition for the clients as possible. Because ultimately, you're not buying AUM, you're not buying a client, you're buying a relationship.
Hello, welcome to this fireside chat about selling advice businesses with David O'Hara and Paul Heath, directors of the advisor network Corbel Partners. Hi both.
Hi Colin.
Hi.
Now, you've already completed 18 buyouts of advice businesses from within your network. It looks a little bit like a downstream buyout model, which we've seen in other businesses before. How is your model different to other consolidators?
It's not technically a downstream buyout. We were asked about 3.5 years ago by one of the appointed rep firms, would we buy the client bank? Because they didn't want to sell to a consolidator. So we had a look at it and we managed to find a way of working. And then when we spoke to other members within the group, there was several more people said they wanted the same thing. So we then put a process in place, made sure it was funded separately. So it was all arranged and put a direct, easy process in place for everybody within the group. Mm-hmm. It's worked really well within the group. They're still not hamstrung. They can go and sell externally if they want to. Mm-hmm. So there's no sort of obligation on that side. But it works for them. It gives them continuity with their clients and everybody's happy with it.
Mm-hmm. And what was the reason? What reason did they mention when they approached you for why they didn't want to go with a consolidator and why they thought that you might be a better choice?
I think part of it is it's around the disruption for the clients. So consolidation isn't a bad thing. It's part of, it needs to happen with the industry to a degree. But there is disruption to clients because potentially you're having to move them onto a completely different solution, different investment offerings, different central investment proposition, different investment accounts, and so on and so forth. And that can unsettle clients and unsettle client relationships, particularly if you've dealt with somebody for 20 or 30 years and all of a sudden you're saying, yesterday everything was fine, today everything needs to change. Mm-hmm. So that was his motivation. So it wasn't because what you tend to find with advisors when they're retiring, there's the biggest motivator is either price or what's happening to the clients. Mm-hmm. And in our experience, it's actually what's happening to the clients is number one on the list. From there, if price is a motivator, obviously the consolidators are way ahead because they'll max out the price. But there's a trade-off with that from there. For what we found with the guys in the group and the people within the group was that they wanted to make sure that the clients weren't disrupted. That was their primary focus, and still have a capital event. So it was trying to find a sort of a happy medium.
Okay, right. Okay. Well, Paul, we've heard a bit about what attracts firms to your network, but what is an attractive firm to you, and how does that compare to what an attractive firm looks like to the open market?
For us, it was primarily designed for internal purchasers rather than the open market. So for us, it's advisors that care about clients. It's all service based for us. Advisors that want to have continuation of service, continuation of products, continuation of advice within the group, and the ones that want to stay. In terms of external, it is about those advisors that want the best for the clients. As David said, with the consolidators, a lot of it is about price, and if advisors want to go down that route, that's fine. It tends to be vertically integrated and to a degree. For us, it's about a good quality service client bank. It doesn't have to be a huge client bank. It just has to be one that's been looked after with loyal clients. We're not necessarily looking for the biggest client bank size, whereas a lot of the consolidators now, certainly with the PE back in the background, they're having to hit certain numbers and they won't talk to the smaller client banks. Whereas for us, when we have talked to external client banks, we've spoken to them. We've spoken to some of the smaller ones that have got 50, 60, 70 clients where they've had a good living, but now they want to retire. They've cared about the clients. A lot of the clients are friends. A lot of the clients are family. Those sorts of client banks are absolutely ideal for us because we can really accommodate that. We're not then fishing in the same pond as all the consolidators to try and capture all the big sales.
And what do you do with the firms once you've acquired them? Have you set up a separate company to run them, or?
Yeah, we tend to move the clients into. It depends on the circumstance. There's a couple of the ARs that we've actually kept running in the background because it just enhanced the continuity. If it's just a straightforward, single advisor retiring, we generally will move the clients into a firm called Mandarin Wealth, which is a subsidiary of us, where we have the servicing advisors based in there, and then there's a handover period between the servicing advisor and the new advisor, or the retiring advisor. Mm-hmm. If we haven't got capacity, we involve the retiring advisor in the recruitment process as well to make sure that the person we're bringing in is as aligned with the way they work as is possible.
Mm-hmm. Because obviously, because you're a network and these companies, these firms already part of your network, you all operate on the same technology.
Yes.
And all the processes are pretty much the same, right? Compliance and all the rest of it.
Yes.
Okay. Now let's talk a little bit about what happens after the sale. You've already alluded to the fact that these advisors you are buying are looking to have some kind of continuity. To what extent, generally speaking, is post-sale friction an issue? Are you coming across it a lot from what you hear in the open market?
I think within the consolidators it is, because we're being approached every day by advisors who have sold, 2, 3, 4 years ago, where it's not what they thought it would be. For us, we don't tend to experience much friction internally because, as you quite rightly said, the processes don't change. If a client has an existing investment plan, whatever it may be today, they will still have it tomorrow because we don't have to move anything. So for us, it's the only friction arises if they don't like the new advisor, which is on personal side. And if that is, we change the advisor from there. So because you need to be aligned to make a successful purchase and a successful integration, both the vendor and the purchaser need to be completely aligned in terms of what you want to achieve, which is basically as smooth a transition for the clients as possible. Mm-hmm. Because ultimately, you're not buying AUM, you're not buying a client, you're buying a relationship. And it's that relationship which has to be preserved.
Yeah. And what tend to be the main friction points after a sale? We already know there's personality problems sometimes. Yeah. Is there anything else that keeps cropping up in firms that you hear about?
The main thing is where clients have to wholesale change what they're doing. So you've had an advisor for 20 years, they're a good friend, you've trusted them for years, because ultimately the advisor-client relationship is about trust. And what's been missed out there, we think, with a lot of the offerings, is the advisor retires, they take the client book, and then they put an advisor in that the previous advisor hasn't met or recommended, and they turn up, and the first thing they want to do is move everything to an in-house platform or an in-house investment solution. And that seems to be the piece that creates the client friction, and where you get clients leaving because they don't want that. Or there's a problem because, well, the advisor's told me, for all the years this is fine, and now you're telling me it's not. And I've got to do all this, and you want me to pay for that as well. And that seems to be one of the biggest things with client attrition, basically, clients staying. Whereas when you don't change anything, that doesn't exist. It is purely down to personality. But if you've managed to get the advisors aligned with the incoming one and the outgoing one, because ultimately the advisor that's retiring or selling knows their clients. So they're the ones really that should have the final say on who's going to take over the clients and who's actually going to have them. Because the last thing they want is a tap on the shoulder in one of the supermarkets saying, what on earth have you done to me? Mm-hmm. I've known you for 20 years and why have you left me out to dry, sort of thing. But that seems to be the main issue. Mm-hmm. But yeah.
And what about fees? Do fees tend to change post-sale? Does that tend to be an issue? Do fees change in your model?
No. So with us, it is complete transition. So the only thing that actually changes is the relationship between advisors. The advisor changes. Everything else stays the same. And we do that deliberately because that takes away a lot of the friction. Where some models have to, again, they have to fit in with a a sort of small box of things, and in there is a set of fees that they have to comply with. And a lot of the time, employed advisors are sent in to sell to them because they've got targets to sell. What we do with our model is we don't have sales targets at all, and we give them credit for all the ongoing income. So there's no pressure for them to sell. Whereas in some of the models that are out there, they have to sell to hit targets, and they have to sell because they have to move it from where it is now to where they want it to be in terms of the sort of commercial pressure to put it there.
And do you ever have any retiring advisors staying on, or do they leave the business in all of the 18 cases that you've bought so far?
We've had a couple stay on because they wanted to, but it's more for them that they're winding out. It's because it's a big step to go from advising today and stopping tomorrow, and it is hard, and we appreciate that. So we work with the advisor based on how they want to do it. So it doesn't stop the handover of clients, because what you tend to find is once they've made the decision to retire, they want to start handing clients over, which is what happens, but they'll still be there seeing referrals and the odd new clients as well. But at that point, they're very much enjoying life, kind of thing from there. And you tend to find that they then say, right, I'm ready to go properly.
Yeah, because sometimes this can be an issue as well, where an advisor all of a sudden it's not his firm anymore, and obviously there's a different situation for them, and sometimes that doesn't go well. How do you manage that?
I think it's because they stay on. We usually try and leave them in a similar situation to what they were prior to sale. So there isn't a great deal of change for them, other than they're dealing with a lot less clients because they are handing clients over. So we don't tend to have that great friction there at that point. Where advisors often struggle is going from sort of self-employed or running your own business today to being employed tomorrow and being told, you have to be in the office by 9 o'clock, or you will see this person on a Saturday, that kind of thing. So, and it's a very, very different, type of advisor. We found the difference between employed and self-employed advisors is that there is a marked difference.
Right. Okay. I see. Okay. And Paul, are there any other challenges that that advisors who are thinking of selling should be aware of, especially if they sell to consolidators?
Yeah, I think the key to the wholesale process is the planning. So the planning with the clients, the preparation, looking at the clients, what the clients have got, priming the clients and easing them all into the process. I think the biggest challenge that advisors have is sometimes they don't look beyond the shiny penny, if that makes sense. They think they want to go because they see the numbers and they think it's a good idea, but they don't necessarily lift the bonnet up on what's going to happen afterwards. So if they're going to join sell their business to a business, then they're going to become employed. As Dave said, that can be a big problem for them. So especially, for example, small directly authorised firms, they may have been doing it for 30 or 40 years, and then all of a sudden they're answering to a big corporate. That's a big piece of friction problem that people don't realise. The other thing we're finding as well is that businesses are being sold to a business that is owned by another business. And then all of a sudden the business in the background decides to have a change of direction, or decides they're going to start to put pressure on the businesses below them to do different to what people thought they were buying. So people actually start to get forced down a route that didn't even exist before they when they sold the business. So I think that there needs to be a lot more preparation done, and I think that people need to do a lot more due diligence on the businesses they're going to be working with. Talk to people that are already there. Talk to people that have gone through the process. Talk to them about, are there any hidden owners? Who owns what? What's the future for those businesses? And start to have a look at what's likely to happen going forwards. And I think as a community, the advisor community doesn't do that. Doesn't do it enough. They go so far and think, oh, that's okay, but then they get a little bit blindsided, and they don't see what's coming next, and that can cause a big problem later on. And we have seen it in the past, and it's when advisors don't necessarily want to retire, they want to stay on, and then all of a sudden they realise that actually this was a mistake, and I'm going to go back to doing what I was doing before. And And we see that quite often, don't we? We get calls from people who say, well, I've been here a few years now, but I just can't do it anymore, or things are changing. This wasn't what it was supposed to be. I want to try and, rebuild basically from scratch, which again causes them problems.
And of course, there is still a lot of private equity money around, a lot of private equity funds buy advice firms. The regulator is aware of this and aware of the fact that it can't always just be the money and the clients come second. Where do you see this market go in the next 5 to 10 years?
I think actually, we've spoken about this several times. We think we're entering a golden age of advice, if I'm honest. PE money, PE in itself isn't a bad thing. It's just another way of raising corporate finance. The problem is that there are a lot of firms out there and a lot of groups out there that are playing the same tired song because they're all chasing the same thing. It's all about AUM and grabbing client banks. And I think the problem is that that's where they don't actually understand the industry, because the industry is a relationship based industry. It's not, you can't buy clients, you can't buy assets. So I think consolidation will continue. I think it'll have to because of the cost of compliance. There is more compliance coming down. You can see the way the direction of travel, but ultimately the industry tends to move in cycles. Where it is today is probably about 10 years after we started originally in financial services, because when we started there was big direct sales forces with insurance companies, small IFA community. They shut down, everyone moved into the IFA sector. IFA sector is now shrinking. Big direct sales forces with the consolidators, and gradually people are starting to pop out the top of those, and the IFA sector then will start to expand again, and that's where we see the industry moving. There hasn't been a new invention in this industry in 35 years. It just moves in cycles, all the way through, and that's kind of what we're in the cycle at the moment where we don't think the consolidators have peaked yet in terms of size. Once they do, it'll then start to change again and move back to they'll start to come out to the IFA sector again, and from there.
Fascinating. Yeah. We shall see.
Hope so.
We shall see. How soon? How soon do you think the peak might happen?
I think within the next 5 years.
Okay.
Because the PE, when PE works on 5 to 7 year cycles, a lot of them have been in now, coming up 5 years, 6, 7 years. Yeah. So they're going to want to eventually. I think we keep thinking they'll start eating themselves. So the PE houses will be buying each other, or the PE backed firms will be buying each other. That will accelerate the consolidation, and then eventually it'll peak.
Excellent. Time will tell. Thank you very much for coming in.
Thank you.
Really good to speak to you.
It was a pleasure.
Thank you for watching. I hope you found it useful. Do tune in to all our future editions that you can find on ftadvisor.com. Goodbye.